Welcome back to the Capital Compounder Show. Today we have a very special guest, and his name is Ghassan Halazon. He is the founder and CEO of Emerge Commerce. Welcome to the show, Ghassan.
Thanks, Robin. Is everyone a very special guest when you introduce them,
Well,
or
there's a very special guest. There's a very special guest. You know, there's
I haven't earned
there's
that one yet.
variations.
I'm working on it, man. But thanks, great to be here. Fan of your show.
Yeah. So at the age of 25, Ghassan, you quit your Wall Street job. What were you thinking at that time?
Yeah, I know the story out there. However, it was written anywhere is that I quit and that was my choice. The reality, as sometimes these stories now that it's 15 years later, I guess I get to say that it was a really tough climate on Wall Street. It was 2010. I was an associate at Citigroup or Citibank in New York on Wall Street, and times were tough. It was like pretty much as you can imagine. You joined the bank in 2008 in the middle of the Bear Stearns and the Lehman collapses and all of that. And so at the end of the day, I had an itch to be entrepreneurial, and I kind of got that sense that I was on the way out anyway because everyone was practically on the way out those days. And so it just kind of propelled me to really think about what comes next. And thankfully, kind of became an entrepreneur or CEO at the age of 25. And hey, 15 years later, I'm still here one way or the other, though not without scars to show for it.
Absolutely. Before quitting, did you already have the idea for Emerge Commerce, or did that come a little bit later?
No, actually, Emerge came along in 2016, 17 is sort of the early days of Emerge, albeit it was very much a second coming of sorts. My initial foray into entrepreneurship and e-commerce was in the daily deal space. So if you remember the Groupons of
Yes.
yesterday, and it feels like so long ago, we had effectively built the market leader in the deal space in 2010, and that lasted about 4 or 5 years. That space consolidated, Groupon came down, and the whole space fizzled, as you know. And that was my sort of early days of entrepreneurship. That was pretty much the first thing that I did. But to your point on Emerge, it really was sort of the second coming of what I viewed as the smarter way to scale e-commerce. In a nutshell, I found that building e-commerce companies from the ground up was oftentimes loss making and expensive, and that buying these sort of bootstrap style niche e-commerce businesses that had a solid brand, but that were running lean and mean and leveraging the Shopifys of the world and the e-commerce enablement software, available in more recent years, that we could assemble a portfolio of profitable market leaders within their respective niches, and that they could share in common ground like resources, back office, technology, and that would be a smarter way to go about e-commerce. And that was the essence and the DNA of Emerge, which stands for Emerge, merging e-commerce companies.
And your Groupon competitor that you built from the ground up, was that WagJag?
No, actually, funny enough, and that all ties in. WagJag was a company we acquired from Torstar under Emerge. It was a competitor of ours in my original business, which ended up merging with a US company eventually, and went in a completely different direction in many other iterations. But when I came to start Emerge, we knew the guys at Torstar, the parent company of the Toronto Star and Metroland. They were our largest competitor in Canada at the time, in my previous business. So there was some relationships, and they were exiting many of their digital properties. They were in trouble, so we got a sweetheart deal, and we started with WagJag. We didn't want to continue in the deal space. It's a very cutthroat space. Churn is really high. We'll talk a little bit about some of the portfolio companies we're in now and why we like them from a metrics perspective. They're very different. But the deal space was our early, let's say, days. It's what we knew best. It was our starting point. We got a great exit with WagJag. We 2x'd our capital, but it was small money, to be honest with you. It was just a great start for us at Emerge.
You're in the news in a big way at the start of this year, Ghassan. You sold Shop.ca and Shop.us domains to none other than Shopify.
Right.
I'm curious, were you the original opener, like on GoDaddy.com, of these domains, or were you a purchaser secondhand and then ended up flipping them years later? What was the backstory?
The backstory is fascinating, actually, and as you'd expect, it probably surprise you. So we had acquired the assets of a company called Shop.ca. It was a functioning marketplace once upon a time that raised capital and was aspiring to be the Amazon of Canada. Which,
Interesting.
as we all know, there ended up only being one Canada globally, so no one is at fault. But the story goes that when we first assembled Emerge, we stumbled on the assets of Shop.ca, and so we selectively picked certain assets, of which these domains were one. So we picked them up through a process, for not much at the time, right? So, and because we got busy buying, going concern companies that, WagJag and other companies beyond there, we built up a much larger portfolio. But, at some point late last year, I was speaking to my CFO about what we had done with these assets. We really never did too much with them. And it turns out they're just sitting there. The domain was still available. And we really hadn't done much with it. Again, we got busy buying much bigger businesses, but it was still a premium domain, frankly, the most premium domain in Canada. So the fun story is that I pretty much cold called Harley Finkelstein, who I'd briefly met in New York. And as the kids do these days, I DM'd him on Instagram. And fortunately, he came back within 5 minutes, put me in touch. Turns out Shopify has a full domain team that does this thing for a living and searches for domains all over the world, as you go figure. And we did the deal within, I think, 9 days. It was right before Christmas, and it was a condition of mine to wrap up the year doing it that way. And lo and behold, it turns out that the shop.ca domain and this transaction was the largest transaction, as far as we could tell, in Canadian domain sales that year, and one of the largest of all time. I mean, I wish it was a .com, because it would have been 10x or more. But it was still a cool $500,000 that we didn't have in our budget, and everyone likes to end the year with a nice surprise like that.
That's a great story. Who owns the .com? Is it Shopify now?
No, I think it's some sort of affiliate style marketplace, completely
Oh,
unrelated. Yeah, and
yeah,
but that was a nice little
that's cool.
surprise. Yeah, and we definitely
Absolutely.
got a nice return on it, because we had valued it at about 1/3 or 1/4 the price we sold it when we initially picked
Yeah.
the domain up.
How do you plan to deploy that cash, the 500K plus?
Yeah, I think it falls into the bigger picture of what we're doing. Obviously, in it and of itself, it's not a lot of capital, but at least it's a starting point that we can plug in and say, hey, we're progressing as a company. We've had multiple quarters of return to growth, as you know, or as you may know, Robin.
Hmm.
E-commerce was a unique, or sort of a unique sector, in the sense that there was a huge uplift during the peak pandemic, right? And a lot of that artificial highs sort of disappeared over time as people came back down to earth and the world moved on. But at Emerge, thankfully, with our current portfolio, we've been seeing that kind of return to growth. So we're deploying that capital in high ROI, quick break-even type opportunities. We're bottom line focused right now, but we're also making sure that growth and that momentum we've seen continues and hopefully accelerates. So that's
Yep.
number one. And number two, just big picture, I do think that the time has come. We've been an acquirer of businesses for a while, but we've taken some time to focus inwards, coming out of that peak, as I mentioned, and sort of coming back up now. And so we're starting to get, serious about inorganic growth as well.
The three brands that we'll get into that roll up into Emerge Commerce, are those operating on the Shopify platform?
No, actually, one is,
Okay.
and the other two are not at this point. We did have some
Okay.
other ones that were Shopify based as well. So it really depends on the niche and the vertical we're in. So to give you an example, our meat and seafood subscription brand, TruLocal, our largest brand by revenue, which is essentially the butcher box of Canada.
Hmm.
Um, that is a unique platform. It's food based. There's points rather than dollars, like in terms of how we transact. So we would have liked to be on Shopify, but it just doesn't make sense. We have a custom build for that one, as an example.
Got it. Are there potential partnerships in the future with Shopify that might continue the story?
Yeah, I'm searching. I'm searching down that black hole to see if we have any other domains to call our friends at Shopify
Yeah.
up, but not quite yet. Certainly we're big fans. I'm personally, an early day shareholder, I would say, since post go public, of course.
Yep.
Um, and I have nothing but the best to say about them and what they've built and sort of how they've moved, Canadian tech forward, right? So great things to say about them. We'll see if there are more opportunities to.
Absolutely. And so the three brands, TruLocal, Underpar, and Just Good Golf. Can we delve into each of those brands?
Right. So as I said, TruLocal is our a premium meat and seafood subscription brand. We connect local farmers and suppliers with a digitally savvy, health conscious audience across Canada, right? And we do it on a localized regional supply chain basis, which means if you're in Ontario and you order, you know that you're supporting Ontario farmers and farms. You're picking your organic chicken, your grass-fed beef, your wild-caught salmon, that sort of thing. And so that is a business. It's a subscription business, so it's a reoccurring model where you get your delivery with dry ice to your place. You can decide if it's monthly, if it's 4 weeks, if it's 6 weeks, 8 weeks. You can pick that cadence. And the idea is that look, you're eating healthy, right? This is the healthiest stuff. It is premium, to be clear. But you're also supporting local and you have transparency of where your food source is coming from. So really we're at the intersection of multiple multi-billion dollar trends, which is why we're doubling down on this business. And I'll also add a little tidbit that I haven't really shared. I'll give you a fun anecdote there. With everything that's been going on with all this tariff talk, and sort of this movement to support local, we've really seen some exciting trends in terms of what that means overall for the segment of local. But at the end of the day, listen, a lot of Canadian brands, will, and I hate to say it, will sort of bandwagon on the local element, which is fair, and I probably would do the same. But it doesn't get more true local. It doesn't get more local than true local, right? I'll say it again. It does not get more local than true local. It is in our heart. It's in our DNA. It's in our communities. It's in the farmers we support. Heck, it's in our name, right? And so I think that this is a big moment. It's not just a moment in time, as I told the team. It's a timely moment to really shift the sentiment. I don't think this is, just sort of a passing feeling, right? We are an angry ex girlfriend or boyfriend, however you want to look at it these days, right? And we're not, we're changing our behavior. Canadians are shopping with, that sentiment in mind, and we're seeing it. We feel that this is a moment for us to shine and to not just be, participating in the local movement, but to become one of the faces of this local movement. So this is a really exciting time. We came out. I don't know if you saw, but we came out with a tongue-in-cheek campaign called TruLocal Retaliates, and we came up with a 25% off Canadian meat and seafood, obviously, opposing the 25% tariff. So a lot of fun with that brand lately, a lot of excitement, a lot of momentum. We think there's big things on the horizon there.
I
That was
saw,
our
and that was really clever marketing at a very timely time, like you say. Um, that was an acquisition. Can you tell us about the origin story? I believe TruLocal was founded by entrepreneurs, and was it Kitchener,
Yeah,
Waterloo?
yeah,
Okay.
absolutely. It was founded by them. The majority of the team was based out of there. We have satellite offices in Alberta and BC because we do national shipments, and there's some folks at HQ in Ontario. I mean, the lines have blurred a bit, but the founding years, basically kind of bootstrapped the business for the most part to the founders' credit, and built a great starting point brand. And when we came in and acquired the business right around the time, they and many other e-commerce companies saw a huge lift. Was super exciting. And from a timing perspective, as the pandemic was winded down, and sort of those artificial highs came down, we really had to double down on, rolling our sleeves up and making sure the business was, effectively run, that the margins were improved, that our cost base was in line with where our revenues were. And finally, I feel like we've come out of that sort of cleanup effort to bring this business back to growth. And we've seen, almost now 3 quarters in a row of reignited organic growth. But I also feel, like I said, it's more than just the numbers and the P&L. It's this local moment and what this brand could mean. It could stand for a lot more, beyond just the meat and the seafood.
Absolutely. And it's direct to consumer, but also you do generate large corporate orders as well through TruLocal. Can you tell us more about the corporate side?
Yeah, and that's a fascinating piece that frankly we hadn't fully planned for. We sort of had a couple of big orders land on our lap, and especially during the holiday season, we had a $500,000 worth of orders. In one case, we had a $400,000 order from one specific client. That's recurred
Nice.
with us a few years now, in addition to a few other ones we've added since. But it's opened our eyes on, if you look south of the border, as I said, you have ButcherBox, which is a $500 million revenue company today. Very impressive number for a bootstrap company. Frankly, one of the hidden faces, success stories of D2C. But then you look on the corporate side, you got an Omaha Steaks, which is, I don't know if you're familiar with them, but they're rumored to be in the 700 million to $1 billion range, and most of what they do is corporate gifting of, you guessed it, meat and seafood.
Yeah.
And so we believe in Canada, you probably, like, a consumer play on its own is probably not big enough if you just wanted to be the face of Canada. So why not be the ButcherBox of Canada and the Omaha Steaks of Canada? And I think that's a multi-$100 million opportunity in it and of itself, organically, excluding M&A. So we are zoning in a bit on the corporate, and you may see more out of where that came from, hopefully.
That's just great. That's awesome. So tell us about your 2 golf brands as well.
Right. So we own Underpar and Just Golf Stuff. Interesting story there. We picked up Underpar in must have been 2019, and interesting dynamics with that business. It was a dream when we picked it up. It was a couple of $1 million in EBITDA. It was a tight ship of 8-9 employees. You had these recurring golf courses that would come on every year at the same exact time. And so it was really kind of I don't want to say an autopilot business, but it sure felt that way when we were doing due diligence. Like, things were just rocking and rolling with relatively minimal, action, right, and effort. And then the pandemic came along, and we had the reverse impact there. So that was a tea time business. We're doing discounted tea times across, sort of all the golf courses and so forth. And so, the pandemic comes along, and guess what? Golf becomes the hottest thing on earth. And now the golf courses don't need us anymore because they're busy. They don't need our discounting. They don't need to bring people through the door. So we had a tough situation kind of dealing with the drop off at the time. But we said we can't just sit around waiting for it. Instead, we said, what can we do? We have 300,000 captive golf members in our database, email members, subscribers. And we said, you know what? Let's take their attention, since we can't send them to the best golf courses anymore while those guys are busy. Let's start selling them golf products and equipment and golf balls. And while we inherited that business from the team we acquired Underpar from, so it was like a small sister site. That was only a $500,000 a year business. Fast forward to today, and that business has 10x'd pretty much in-house.
Incredible. Organic, yeah.
Organic, yeah. I don't believe we've hired any full-time people to scale it from $500,000 to $5 million. It's just
Even better.
Right. So we had a bit of an unfair advantage or a secret sauce, given we have all this, these members. And that's the power of the Emerge model, in a way, in the sense that, we are leveraging what we have here like with our hands, with our sleeves rolled up, and we've been able to do that multiple times. And that's one such case, probably one of our better ones. We've 10x the brand with no outside hires or support. And the good news on the Underpar side is, finally, after a multi-year hiatus, with the economy weakening and cooling, not that we wish that on anyone, that's brought back A
Yes.
lot of the old golf courses, the premium golf courses that now starting to need our help bringing people through the door. And as we've reported, we've had multiple, kind of consecutive quarters again with golf growing and shining as well. So both areas that TruLocal's growth right now with the local movement, with all the restructuring we've done to start growing and being more profitable. But then you got the golf sides also shining, and so we're very excited at this moment in time about the this core portfolio that we've doubled down on.
That's fantastic news. Are you a golfer yourself, Ghassan?
I am not. I am
Okay.
not. And when people say, "Hey, do you golf?" I say, "No, but I
Yeah.
own a golf business, right?" It's like, I better, I better figure this out at some point,
So grocery and golf, the two
right?
themes of your current portfolio within Emerge Commerce. When you do go out and start acquiring e-commerce companies again, do you plan to just bolster those two categories, or are you going to look outside of those categories?
So I'll tell you, Robin. Once upon a time, we had what I would call the 1.0 model of Emerge. We had a diversified, decentralized portfolio
Hmm.
that had a wide ranging group of eclectic assets and verticals. So we were in pets, we were in outdoor gear, we were in experiences, as we mentioned with the deal
Hmm.
space. Of course, we had grocery and golf, and so we had a quite a large portfolio, almost 120 million in GMV at the peak, at gross merchandise volume. Um, and one of the hard decisions we had to make was in light of a lot of that sort of coming down from the peak pandemic artificial highs, and at the same exact time, I might add, interest rates went up on the debt that we had used. A lot of roll-up companies had to recalibrate, and so our recalibration entailed us doubling down in specific opportunities that we thought we could win big at, right? And that was a decision that culminated in the sale of wholesale pet to Tiny. Tiny is a
Hmm.
well-known holding company here in Canada and North America. And we sold that business for about 13 million Canadian and sort of cleaned out a bunch of the debt left, in addition to us selling other non-core businesses. And we said, you know what? Out of all of these, we're going to go back to our core. When we went public, we were really focused on golf and shortly after grocery with
Hmm.
TruLocal. And we said those are the businesses that are operated out of Canada. B, we know a thing or two about. We've really been close to these businesses. We think we can impact them. C, we love their unit economics and kind of like peer set, like when I talk about Butcher Box or golf now. These are big businesses. We really think we can be the kings of Canada in both these categories. And so we chose to double down, and so far so good. Almost 14 months into that decision. As I said, we've reignited growth. Our profitability is way up. Shopify was a nice little surprise to end the year,
Yeah.
but sort of big picture, we're feeling really good about that decision to go more centralized, more focused, and we're rolling our sleeves up and operating these brands ourselves now.
When you triple down and you decide to go into market to make more acquisitions to bolster those categories, what are tell us about the acquisition criteria basically
Yeah.
when you go out.
It's super exciting, and
Yeah.
that we gotta get to start thinking a little bit about M&A. That is in my DNA and in our DNA. It's kind of what Emerge was meant to do.
Hmm.
I think moving into the centralized model and focusing on grocery and golf, I think two things. One, obviously, you got geographical expansion and doubling down, growing market share in exactly what you do. Now that you have a playbook that's working, whether it's the TruLocal business and how we've defined we're market leader there today, but how we've improved it, how we've reduced costs, improved margin, reignited growth. These are things we can apply to other brands and just gain some geography and some scale
Hmm.
and some talent, of course. And likewise, let's say the playbook we've developed between Underpar and Just Golf Stuff. That also means that the next Underpar competitor, once we acquire that, for example, we can layer in all the secrets and synergies we figured out with Just Golf Stuff in that same vein, right? So there's some of that more like obvious geographical and synergistic like tuck-in style stuff. But then there's also the types of acquisitions that might supercharge the whole portfolio or part of it. So you gave me an example of corporate orders with
Yeah.
TruLocal. There's certainly a fair share of corporate platforms out there that specialize in that sort of stuff. And, those are acquisitions that may make sense, of us adding on, a B2B layer to what we're doing is certainly something I find super compelling. So I think there's, just to, quantify it a little bit, I think both the TruLocal opportunity and frankly, the one of the faces of local opportunity, I'll call it, as well as the golf opportunity, are both multi-$100 million opportunities in their own right.
Mm-hmm.
And I think supercharging them could lead to sort of bigger levels than that.
This is great. So strategically, you talked about the journey to pay down debt. Where are you in that journey, and what's the debt position now across the company?
Yeah, I mean, that's sort of the joke around here is, where do you think I got all these gray hairs? It's been a journey, all right,
Yeah.
Robin. We, to give you an idea, at our peak had 30 plus, almost 32 plus in net debt. So like sort of a senior debt facility that was 25 million. We had kind of 5 million plus owed to brands. We had a couple of million in sub debt and so forth. Long story short, after having cleaned house and sold our non-core businesses and paid down the debt, we find ourselves, with net debt, a net debt position of just below 5 million, from 32. Emerge collectively still has about, 30 million plus in GMV, I'll call it, and 20 million or so in revenue, give or take, and just sort of on run rate basis, it can be extrapolated. That's sort of our baseline now. Obviously, we were multiple times the size previously, but what was the point of that size if the cash flows were getting drained by all that debt, right? So we have a tighter ship. It's way more profitable right now from a pure brand perspective. Our debt is lower. Obviously, interest rates are going down. So I kind of say what brought us down, meaning declining revenues from that peak pandemic, as well as interest rates going up at the same time, those two trends are reversing. Revenues are growing now. Interest rates are coming down. We're focused. We're ready to rock and roll here for this next phase.
Debt is more manageable, exactly. So I recently talked to Jonathan Ferrari, co-founder and CEO of Good Food Market, and there's a little bit of overlap here, I think, in the business models. But he recently announced on Jan 16th that Good Food Market implemented a Bitcoin treasury strategy. Now, if you look out 5 to 10 years for your own business, would you execute on any similar Bitcoin strategy?
Yeah, so that was an interesting one. I did see that. Obviously, we know Good Food. There's sort of a broader player in the food space. Obviously, we're focused specifically on meat and seafood versus meal kits. But the Bitcoin choice is an interesting one, and I don't think to know enough about their decision making or details of their business. I certainly, on a personal level, I'm a believer in Bitcoin in particular. I could say I'm an investor in Bitcoin in a pretty meaningful way, I would say. I think from a company standpoint, the one thing I would say is, you have to be in a position of strength, and you have to have meaningful dollars. If you want to do a symbolic thing, that's fine. Not saying that's what they're doing, by the way, but I think that I would certainly entertain it, some portion of it. We all know what's going on with the money printing and the devaluation of the dollar and so forth, and currency in general. And I think Bitcoin has a special moment right now, despite the bloodbath over the last couple of days. And I think that it's here to stay. If BlackRock is here, if the UAE is here, at the table, if people are right, El Salvador, etc., Argentina, things are moving. Things are moving. I think it's here to stay. I think it's. I don't view it as a productive asset by any means. I view it as I'm in the camp that says this is sort of the modern day gold.
It's
right?
a hedge, yeah.
Right, it's a hedge, and it's a smarter hedge, frankly, over time. And I think our generation and the younger generation, I think there's buy-in, and I think it's here to stay. So I would do it if I were a Shopify or a Lightspeed or even somewhere in between. If I were a $1 billion company, I would certainly take a view of it. What I wouldn't do, which I can see the temptation sometimes. What I wouldn't do is become so correlated to it that sort of kind of overtakes my entire business, right? I also think there can only be one micro strategy, frankly, at that level. And by the way, the verdict's still out there, obviously, right? Like that could go very, very wrong. It has nothing to do with Bitcoin, but that could go very wrong, and it could be brilliant too. But I'm a believer. I'm long. I would consider it prudent to have some sort of allocation if you can afford it, and if you can afford losing and going through the volatility of it. But I think better days are ahead, and I think it's going to prove to be smart for some of the bigger companies that can afford to put a decent portion on.
Yeah, that's really interesting. Tell us about your board of directors at Emerge Commerce, because I believe there's some connections to other Canadian companies here.
Right. Yeah. No. So we're very fortunate with our board. Currently we have it's a tight board. We only have 3 people in addition to myself, so we're 4 people in total. You have Drew Green, who's the CEO of Indochino, the suit company. Then you have Ian McKinnon, who most notably was a board member at Constellation Software. Not sure if you heard of them, but he's been at this point, right? 16 years on the board of Constellation. Front row seat / contributing to Mark Leonard was is always something exciting and special to have someone of that level of acumen and support. So terrific board member, great mentor, as well as John Kim, who most notably sits on Well Health. Obviously, another great success story. Also, follow that story closely. Saw Hamid on your pod, and they've done some great things. We really like those guys, and John has been a very astute, very professional board member. So great to have all 3.
That's just great. So you mentioned, I believe, a $20 million run rate. What's the growth projections going forward?
Yeah, so we don't officially give guidance, but what I'll say is based on our preliminary results from Q4, I think we mentioned 16 to 17% in top line growth. Yep. Overall. And you got your GMV, you got your revenue, but I think call it 16%. And I think that double digit growth is been an incremental move back up. So obviously we had multiple years, let alone quarters, of decline from the peaks, pandemic peaks. And in the last 3-4 quarters, we've really turned that curve around, and what started as 3 to 5 became 7 to 9, became to 11 to 12, and now we got to a healthier clip. Mm-hmm. And I think that obviously we're not permitted to chat about exactly what we're seeing now, but all I'll say is obviously I really believe in this local movement. I really think this could be a very special moment for TruLocal in particular, our largest business by revenue. And I think the golf business tends to gain and is gaining out of, let's say the weakness in economy, the need for golf courses to rely on discounting and things of that nature. So I feel like we're quite uniquely positioned. We're tariff insulated in a way. In fact, if anything, we're gaining from all this BS that's going on. And I think the golf side also is well positioned.
How was Black Friday and Cyber Monday sales last year for TruLocal?
You know what? All of it went great. It was double-digit growth. We reported on it. It feels like so long ago. I know it was only a few months ago, but man, a lot's happened. It's only a few days. It was amazing for us. We reported it. So anyone who's interested in seeing those results, I think we broke $1 million in sales in that Black Friday, Cyber Monday period. However, we defined it then, and that was great to see. I think every year you go into it, it's a lot of preparation. It's a disproportionate amount of revenue for the overall year, and yet you never really know how people are going to react. Thankfully, is a big success, and we saw even a more pronounced growth rate than we had been in the prior quarters.
That's awesome. What's your advertising revenue for TruLocal? Is it mostly social media?
I guess you mean like sort of our advertising budget, how we spend it. Yeah. So I think generally I would say it's a mix and match. Clearly Facebook / Meta and Google sort of rule the day in terms of percent spend. But we're also pretty deep in with influencers. We're deep with banks who have audiences in different ways. We're an Amex partner on Amex Offers, one of the few curated businesses to do so.
Oh, it's good to know.
Yeah, we have some fitness folks that we do some affiliate work with. We have some influencers. I'll tell you a funny story.
Sure.
someone just ordered like their, I think it was like 200th box, and we wanted to do something special, but then we were working the math out. We're like, how the hell did this person join at that date but has 200 boxes? Something is off. So we wanted to do a fun like social segment, go chase this guy down, figure out what his story was, like make him a bit of a, a legend. And we found him. Eventually, we found out that he had this like whole gym crew behind him. So he was ordering for all of
Protein. They
them.
need lots of protein.
Yeah, exactly. So he was a super fan, of what I understood. But it turns out there was like 10 or 20 people behind him. So and we don't mind that at all. We don't mind that at all. But we keep it fun. We tell a story. We try to be authentic and highlight our farmers. And we're pretty, I would say, pretty edgy lately. We're trying to really mix things up. When Canada beat the U.S. The other day in
That
the
was a great
final,
game.
we pretty quickly came out with homegrown heroes segment, and we had
Nice.
hockey and we had the farmer like
Yep.
side by side, and that was like a big hit. As I said, the TruLocal retaliates. That's actually something I came up with
That's cool.
personally, and so we really love like kind of letting that brand shine in a time like this.
Are there any differences or nuances in when you advertise the two golf brands?
Yeah, totally. You can just, I think like one is experiences based. It's about golf courses, and it's only advertised. For example, we don't do every city and every region. So Ontario, we're huge. We're huge in California, especially SoCal, Southern
Okay.
California, Florida, Texas. So we have some U.S. Exposure there as well. And so, generally there we're kind of focused on the big, like I would say fewer bigger discounts, not like thousands of courses, but rather like what are the best 20 to 50 offers out there? More like a hotel tonight than just a long tail Expedia or Open Table, if you will. We're more like, here's the really hot stuff that you want in your inbox daily. So that's kind of the Underpar side, is like we're advertising more like the courses, the beautiful, kind of imagery, etc. Versus with the Just Golf stuff, which is more apparel and equipment. It's more like kind of think of it as a clearance hub for like great brands like Adidas, like Callaway, TaylorMade, etc. Right? So that we're kind of like, here's like these great discounts on these sorts of items, right? As though you're going into a closeout shop, if you will. A lot of time.
And what about the retention rate across the brands, and what is your loyalty program strategy?
Yeah, it's a really important question. We
Yeah.
don't break out per brand or even give metrics, but this is what I'll tell you, Robin, which is I
Yeah.
think what you're getting to. The reason we decided to double down on the grocery and the golf, and I know it's odd, most people say, well, what the hell is this grocery and golf portfolio? It's just what we landed on, right? We had this diversified portfolio, and we said, look, these are the ones we can really win at. It doesn't matter if it looks natural or not. Like these happen to be the ones that we really believe in and have great conviction in. So from a CLTV, or from a customer lifetime value relative to customer acquisition cost, this is the holy grail for a model like TruLocal. I can tell you, and this is public, that we see about $1,700 in lifetime value from a single customer, but they only cost us something like $150, right? And so on a gross profit basis, the 1,700 is closer to, call it, $500. That's still 3 times more than the cost of acquiring them to become a monthly member. And so we really feel like we're in the money with that ratio. And if anything, we want to double down and grow that. And I think this sort of momentum has the potential to, at least for the medium term, bring down the cost per acquisition as people gravitate towards local offerings. So that is a very special formula. I've looked at a lot of companies. I've been in the middle of a lot of D2C businesses. We own 9 brands. I've probably looked at hundreds by now.
Yeah.
And it's a very special CLTV to CAC ratio, as they call it. I think with Underpar, what we love, some of the dynamics we love, and in golf in general, the golf audience, man, they're cut out different. They don't,
Yeah.
they're not as difficult as customers. They don't refund as much. They don't complain. The golf courses are never too busy. They have big surface area, unlike a restaurant. If you give a voucher, you go in, you're angry, you tip, you don't tip. So we feel like these dynamics are conducive to long-term behavior. And by the way, like Underpar has been around since 2008. It was actually founded during the Great Recession of 2008. And so this model thrives in downtimes. And unfortunately for the world, but maybe not so unfortunately for us, I think that Canada's in for some tough times. And I think a model like Underpar tends to thrive there. I also think we're in for very local times, and I think that's going to be very good for TruLocal.
Yep. What's the background story behind Underpar? Like, you piqued my interest here. Was it an American founder, a Canadian founder?
Canadian founder, through and through.
Okay.
Good guys.
Yeah.
As I said, they built, to their credit, a very lean, profitable business when we acquired it. We've had to work, I don't want to say double, man. It's probably triple as hard just to try to catch it up to where it once was.
Yep.
And thankfully, I mean, we're growing again and we're approaching, those levels. Again, it was $2 million EBITDA business with 8 people, you can imagine. But they built a great brand, great name with Underpar, right? Amazing name. Just sort of a seamless site. They've done very well with the tech of it. It's all like integrated. And they have amazing course relationships, golf course relationships. Everyone knows the name Underpar in the golf space. Certainly we're focused on public courses, so it's obviously we're not catering to the privates as much. In the US, there's more stay in plays and international stuff coming along too. But yeah, that the essence of it was a couple of golfers came along and kind of built this up bit by bit, and very bootstrapped, to their credit. Admirable brand, and we're carrying that legacy and building on it, obviously.
That's really interesting, and it makes complete sense now why it was born out of the financial crisis, because all these golf courses were in such need to promote and to attract golfers. What have been your biggest learnings, Ghassan, since IPOing?
Wow, man! We got plenty of learnings to share, and to your views. I wasn't fully prepared for this, and I'm going to think a little bit. I do. Ooh, man! I think. Look, here's one that I can think of off the top of my head. You heard me say we started with a decentralized model. Yep. I mentioned Ian McKinnon from Constellation, who was on our board. Funny, when we started, we wanted Emerge to be the Constellation software of e-commerce. And everyone in Canada wants to be the Constellation of X or Y. But it turns out there's only one Constellation for a reason. But I'll tell you why that model didn't work for e-commerce, specifically consumer e-commerce, which is why we've pivoted into a more centralized, focused brand strategy. I think in e-commerce, the difference is consumers are generally fickle. Unlike with software or SaaS, government contracts where you just raise prices, sit back, no one notices kind of thing.
Yep.
In consumer e-commerce, you got to fight. You got to fight daily and prove yourself and build a brand and earn that thing and have community. And I think the one thing that we really did well there was that we actually did buy great brands, again, to those founders' credit, with a lot of passion, a lot of heart, a lot of community-centric stuff. And that's invaluable. And that's what keeps you above. You can't just fight on price, i.e. the deal space, which we got the hell out of. You got to build something that people respect, that admire, are inspired by. You got to, evoke emotion. And I think we do that very well, naturally and authentically with TruLocal and with the golf business, with Underpar and JGS. And so I think that's one. But, the learning to me was, there's always this temptation, especially in roll-up stories, to just, on paper, sit at HQ and buy a few things and let a few founders continue under their earnouts. Well, it doesn't work that way, especially when the world is as crazy as it is these days, right? Those same founders that build something from 0 to 10 or 20, they ain't sticking around when it's cloudy and stormy. They don't need to. You've made them millionaires. They're not interested, right? And so when you're coming in trying to say, hey, let's roll our sleeves up, let's right size, let's cut back on commitments to folks on the team and so forth that don't make financial sense anymore, or maybe never did, right? That you were tolerating if things were growing so fast. Yep. There's all these hard decisions, and I think that the best thing you can do is try to stop if you think you're doing something wrong sooner, as soon as you feel it. Generally, like I feel like every time I was onto something, that person is off, or the way we're doing it is off, or why are we overcharged here? Like most of the time I knew it just takes some time to get to, and you gotta prioritize stuff you for sure know. That's another lesson. And hey man, I can keep going. There are no shortage of lessons, but I think it all boils down to the fact that, once go full force ahead. Yep. And I think focus has been a wonderful thing, for what it's worth, for any listeners that are running businesses that are going through trials and tribulations. It's like we're in a really tough predicament. We had 32 million in debt. Our share price was plummeting. we lost confidence from everyone around us, and it would have been the easiest thing in the world for me to bail and say it was tough and all these micro caps and all these stocks are in the drain and there's so many CEOs that left. But
Mm-hmm.
I said there was something honorable and exciting about sticking around, cleaning it
Mm-hmm.
up, and bringing it back to life. And that's exactly what we've done. We're not, as Kobe says, job not finished, job not
Yeah.
done. But we feel like, there's great energy now. We feel that, as I said, the interest rates are coming down, the revenues are growing up, our costs are coming down, and we feel that, this is our year to come out and start shining again.
And so, speaking about priorities and coming out shining, what are your key priorities for this year, 2025, for the company?
Yeah, it's got to be, continue momentum. I know that's the boring talk, but continue that growth momentum organically that we've been seeing over the last 3 or so quarters,
Yep.
and maybe accelerate it. Certainly think that's a real possibility. I would say that continue to be opportunistic with, potentially reducing our cost of capital on the debt side and reduce
Mm-hmm.
interest cost. So that's another part of it. And then thirdly, I would say we're ready, rolling our sleeves up. We want to be opportunistic inorganically. We want to reignite that acquisition engine and that program, but we want to
Nice.
do it with opportunism, if you will, right? We're not here to overpay or pay anything for anything sexy. We're not interested in anything sexy at all. We want to buy good old boring cash flows. We want to do it and structure it in a way that favors what we need for this moment in time. And we think that adding that profit to this mix of already organically growing businesses, I think could be exactly what the doctor ordered for Emerge
Yep.
Commerce to rise again.
So, in terms of scouting, like for deal flow, is that you, Ghassan, or do you have someone internally at the company
Yeah,
who
we
takes
used
care
to
of all
have
that?
an M&A, sort of a mini M&A
Yeah.
group of folks, and obviously over the last couple of years we have not been acquisitive.
Yeah.
Right now, obviously, I wear my banker hat on. Definitely have a fair amount of, let's say, starting point relationships in both categories in grocery and golf, where we have about, I don't know, 4 to 7 players in each of those. And of course, as I mentioned, a couple of players we're speaking to in, let's say, supercharged verticals that could help lift the whole vertical, the whole
Mm-hmm.
portfolio. I'm kind of doing some of those conversations myself. I have a few, consultants slash brokers that I speak to occasionally, but we're not here to buy like 5 companies or anything. I think we want to kind of dip our toes and figure out the next right one. And we have conversations, to be clear, and we think we'll do something. But I think over time, as we start scaling, of course, naturally, we'll consider kind of more full-time resourcing around M&A, but we don't need it right now.
Which leaders out there, which larger companies do you look for inspiration from?
I would have to say that I'm a big fan of Butcher Box in our category.
Yep.
Obviously, they're the big elephant in the room. They're only U.S. Focused. They have no
Mm-hmm.
presence in Canada, and they built 500 million to 500 million with no capital raised, which is
Wow.
remarkable.
Yeah.
Remarkable, especially so in D2C consumer e-commerce. Like that is unheard of, right?
What were the key drivers to that, success from zero? Like,
Yeah,
how did they do
listen,
it?
I think if it's fascinating. There's some really good
Yeah.
podcasts on them, and the founder's actually quite open. And I've met him and spoken to him a few times.
Yeah.
I think that they credit some of their early learnings with regards to pushing out supplier terms, getting suppliers essentially to finance their business. I think
Yeah.
is one thing, and I think we do this very well at Emerge. I think they jumped on the early kind of keto diet style influencers and stuff like that. Like I think they did a disproportionately good job of it. And listen, they're just smart, shrewd operators, right? And so to me, I think just to frame the opportunity, I think, obviously they have their eyes set on getting to 1 billion over the next 4 or 5 years, I imagine. And I think that, TruLocal can be 100 million plus opportunity on its own here in Canada. And that's excluding corporate and that's excluding inorganic
Mm-hmm.
acquisitions. There's certainly a fair share of, target companies that we think we can go after. So I really like this vertical and this niche. And much like you heard me say, it has some of the most attractive CLTV to CAC ratios out of
Yep.
any space I've seen. That also is probably something I don't know for a fact, but it's something probably ButcherBox sees as well in those economics, and therefore they're able to scale tremendously, right? So I do think that's a great precedent. I think outside of e-commerce, initially, as I alluded to, I think Constellation Software and frankly the Well Healths of the world, like I think these are great inspirational stories. Some, not all are equal, and some have their flaws for sure. Certainly, most have have flaws. But I love great capital allocation CEOs and stories. I love your program as a result of some of these people that you bring on. So to me, while we on the consumer e-commerce side have rolled our sleeves up and are operating these businesses, I have a great passion for capital allocation.
That's awesome. So for the this is final question for the fellow entrepreneurs who are listening in and viewing, what books have you just loved to read again and again to help you scale, help you think about business?
I know everyone has like some sort of canned answer, prepared response to this one, or had some book or two that they've used. And first of all, I've never read a book more than once. I've barely read any book fully. But I definitely, back to capital allocation, you've got to bring up The Outsiders. You've got to bring that book up. It's one of my favorite books. Such an easy read. Such a, like, you know what I mean? Like, you just want all of that information, that knowledge. But I'll tell you another one. And it was by Brad Jacobs. And I think it's called A Few Billion Dollars. I'm pretty sure How to Make a Few Billion Dollars. That's what it's called. Brad Jacobs is a prolific serial entrepreneur. We don't know too many CEOs that have built multiple multi-billion-dollar companies. He's one of them. I don't know if you know him or you've heard of him, but
I need to read the book now. It's going on my list. Yeah.
Man, I'm telling you, like, and this book was, I was consumed by it. And I'll tell you, I will read it again. Okay.
Yeah. You're going to break your rule.
Yeah. No, it's a special book. He's a special operator. I don't think enough people know about him, but he's the guy behind United Rentals and a bunch of other more old school equipment style roll-ups. He's done some trash or junk company type roll-ups, and I really love the content in that book and just the openness, and it's a mix and match. It's not just like a manual or instructions. It's storytelling. It's inspiration. He's also a little bit into like this Zen style way of thinking. So you'll get a mix. It's a really compelling book. So I'll pick that one.
Yeah, awesome. This has been a lot of fun. Ghassan, I wish you the best for 2025 and for Emerge Commerce. Thank you very much.
Thank you. Really appreciate the time, Robin. Cheers.
Cheers.